Yeah, Sahil, that's fine.
Okay. Fine. So, good evening, everyone, and welcome to the Tata Metaliks Q4 FY22 earnings conference call hosted by Monarch Networth Capital. Just a reminder that all participant lines are listen-only mode right now and muted, and request you to keep it on mute for a proper conference call to happen. And after the initial remarks from MD sir, we'll open the floor for questions. The manner that we follow is that you shall have to raise your hand, and I'll unmute you, and you can go ahead with the question. A request to limit the questions to 3 so that everyone gets a chance. Over to you, Sandeep sir, for the introductory remarks. Thank you.
Yeah, thanks. Thanks, Sahil. Thanks, Monarch, for organizing this. Welcome to all the investors and the analysts. Thank you very much for joining the call. I think the quarter 4 results of Tata Metaliks has been a bit of a mixed bag. While we have achieved, I would say a higher profitability compared to quarter 3, but we could have done much better. And I'll explain to you the reasons for that. Essentially, I think if you look at also the overall numbers for the year, we have reached a revenue of 2746 crores and with a profit before tax of 339 crores, which is the highest ever profits for the company. The second highest or the previous best was last year at 307 crores. But this also includes sale of land from our Maharashtra asset, which was lying with us for quite some time and which we had discontinued almost about 9 to 10 years back. So there was a windfall gain of almost 31 crores coming in from there. So overall, if you look at the profit before tax, is more or less similar to what we had last year, which is it comes to about slightly better than last year by 1.5 crores. If you look at the sectoral performance and just the highlights, we have the highest ever operational performance. The blast furnaces have produced the maximum hot metal at 565,000 tons, which was the highest ever. The DI pipe production has also been the highest ever at 236,000 tons. Coke plant has also been the highest ever. Power plant is also the highest ever. And of course, the sales of both pig iron and DIP have also been the highest ever, with the lowest ever inventory of pig iron and DI pipes. Our collections have been the best. Cash position is also very, very robust. So all in all, it's been a good performance, but it's been a mixed bag in some sense, and I will tell you why. So our profitability got impacted in quarter 4 due to, let's say, 3 or 4 reasons. Number 1, there was a huge surge in the raw material prices, particularly coal. You must be aware that the prime hard coking coal reached a level of almost $670 in quarter 4 before coming down. Coke price. So let me say, if we were to convert that into rupees per ton, today, or rather in the month of March, the prices of coal, average prices were upwards of 50,000 rupees per ton, compared to, let's say, less than 40 in the previous quarter. Coke prices crossed 60,000 rupees per ton. So, both coal and coke had a huge impact. Then, though the pig iron prices also, moved up, and particularly in the month of March, and we were able to cover our costs in pig iron quite well. But it took a little bit of time in January and February before the prices of pig iron could move up. So this was one reason. So the huge jump in raw material prices is one. Second reason for the profit being impacted is that our ductile iron prices are still, I would say, not gone up to the same level as what we would have expected, primarily because we are carrying the old contracts of FY21, and even though we have executed a very large part of it, but it came to haunt us in quarter 4. So the old prices, the drag of the old prices continues to haunt us in our profitability. So that was the second reason. And of course, the third reason is that even though we had an all-round operational performance, which was the best ever, the blast furnace in particular got impacted because of the time taken to, let's say, stabilize one of the blast furnaces, the bigger one, after the shutdown. And we had been facing this problem with this blast furnace for some time. And the second blast furnace is due for major overhauling and repair, so we can't ramp it up. So on the blast furnace front, we have had a problem, while coke oven, sinter plant, power, DIP, all have been very, very good. And the final reason for the impact on profitability, the four key reasons, as I was telling you, is the royalty that we have paid, the additional royalty which Tata Metaliks had to pay because of the government regulation which came in for increasing the royalty on iron ore from 15% to 37.5% for fines, and for lumps it went up from 15% to 52.5%. So if you buy from a captive mine owner like Tata Steel, you have to pay that much extra. So this also impacted our profitability, and the overall impact of this for the year has been huge, has been upwards of 150 crores. So if you actually look at our profit, our profit before tax number compared to the last year, we should have been higher by that number. But because of this impact, we have been lower. So despite the brilliant operational performance all over, other than the blast furnace, we still got impacted. On the positive side, the profitability has been helped by, as I said, surge in pig iron prices, excellent operational performance, and of the plants. So this is the summary, and I will close at this, and I look forward to the questions and any queries that you might have. I'll close, and I'll just ask Shubhro if you want to add anything. Shubhro Sengupta is our CFO.
You have covered everything, but the price of other commodities like zinc, magnesium, that has also got like haywire in last 6 months, and the DIP conversion cost, all raw material cost has got a huge push, and the coal may be the highest impact. The others also got a substantial impact of another 10-15 crore kind of. Other things you have covered.
Right. Thanks, Shubhro. So we are through, Sahil. You can start with the questions.
Right. Thank you, sir. Thank you, Sandeep, Sanil, Subir, sir. So now, investors, whoever want to ask a question, they can just press the raise hand button, and I will unmute them, and they can go ahead one after the other. So just we'll wait for a minute. I'll wait for the question queue to assemble, and then we'll go ahead. Yeah, Dhaval Joshi may go ahead and please ask your question.
Yeah, hi sir. Good evening. There's a couple of questions from my side. First, can you give us the trajectory of how the DI pipes sales would be for FY23, and from when or which quarter we could see better relations in terms of the higher price contract to flow in to inject the profitability?
Yeah. Thanks, Dhaval. So, I missed one important point, is that the expansion project, the first phase, which we were supposed to commission by March, April, is actually under commissioning, and we should start commercial production by next month. Despite the fact that the overseas engineers are not able to come into India because of the COVID-related visa restrictions, and these are primarily from China. So they face the maximum, problem. Currently, they are also facing this wave of COVID. So, but we hope to. We are actually using augmented reality, a digital technology, to commission the plant, and different equipments have already been commissioned. The rest are in the process. So let's say sometime next month, if we start production, then if we did, let's say about 230 to 240,000 tons of DI pipes this year, then in FY22, then in FY23, we should be able to do, let's say, anywhere between 280,000 to 3 lakh tons or even more, depending on how fast we commission and stabilize the plant. And the second phase would then get commissioned by, let's say, early next year. That's the plan. So that's on the quantity. As far as the prices are concerned, just to give you a sense, the prices of DI pipes, let's say in last year, if let's assume the numbers would vary, but let's say if they were 50,000 rupees per ton, then today those prices have moved up by at least 50 to 60%. And we have been booking orders, I would say, right throughout the year, but more, let's say, more of these orders we have booked in the last 3 to 4 months. And let's say almost 60-70% of our total order book in FY23 would be of these new orders. So the old orders, which come in at older prices, would still comprise, let's say, at least a third, if not more. If that gives you some sense, Dhaval.
Okay. Thanks, Tata. So can we fairly assume roughly around 20% kind of increase in DI pipe sales from FY22 with the new commissioning of the plant?
I think that's a fair guess. It could be even more. See, because what's happened is that, since the commissioning is not being done physically by the technicians, so there are some doubts as to how effective they have been. So we may take a little bit more time to stabilize. That's the only concern. Otherwise, your guess is actually conservative. We would like to do much more than that. But I would like to keep that a little bit open and see how things go.
Fine. And sir, full ramp up and full benefit of, as of now, our WHR capacities and coke oven has been already built already came in the numbers, right? In Q4. Is that assumption is right now?
Yes. So both power as well as coke plant, we had expansion of coke plant, we had put up a new power plant. I would not say the power plant has given us full benefits, but whatever was our plan, it has given us more than that. Even in the coke plant, whatever was our planned capacity, we've actually produced more than that. So we are right now at, you can say, close to 100% of the capacity, theoretical capacity. Practically in the power plant, we can even go higher, but that's dependent on a lot of things. So to answer your question in a nutshell, yes, Q4 has given us the full benefits. Shubhro, you want to add anything here?
No. So coke oven and power plant are running in full swing. So that is already covered. But in subsequent years, we have also got other cost-related projects which will come up mainly on the further sinter, further agglomerates, and also the further oxygen enrichment. So that may come in FY23 part and in FY24 subsequently.
Okay. And sir, last question from my side. I mean, what is the status of Tata Long and Metaliks merger? I mean, can make us clear that.
So I would, like to say that, you will get to hear from, I'm sure you will get to hear from Tata Steel sooner than later about the exact status, because of various things that have happened. We have been telling you that the procedural delays are happening, and there are lots that in between. There have been lots of challenges which have come up. So I'm sure I would not like to attempt to answer this question to get you confused, but I'm sure you will get an answer sooner from Tata Steel on this, to give you the current status, what's happening, and where do we go from here.
Good. Thanks.
Vikas Singh, you can go ahead and ask your question.
Good evening, everyone.
Good evening.
Am I audible?
Yes.
Hi, sir. Thank you for the opportunity. Sir, I want to understand our strategy with respect to our iron ore procurement, since we are giving almost 150% higher royalty than what we were previously. So why we have kept purchasing from Tata Steel? Is it a logistical problem or the pricing is still lower even after giving the premiums to Tata Steel?
So very apt question. So we don't buy only from Tata Steel. That's number one. Number two is the Tata Steel iron ore has certain advantages, which from a value in use gives us that benefit, right? So this is number two. Number three is the logistics. It has its own siding, so it's easier to get it. Okay. And number four, which is the most important, is that on a like-to-like basis on the market, if it is not making sense for us, then we would not buy, because we also buy from the marketplace. So it does make sense, and therefore we continue to buy. We get long-term discounts. So keeping that into account, it still makes sense, but the percentage of buy from the market has increased. Shubhro, you want to add anything?
No, you have covered. Say, because the two parts. One is the fines. The fines, the market royalty is also 150%, be it OMC, be it NMDC. So Tata Steel is very much competitive. On lamps, the royalty is higher compared to the market, maybe OMC and NMDC. But Tata Steel quality is much, much superior than the normal market availability on Fe or silica, alumina, and phos, or whatever there is. And what this has already covered about the logistics and availability and consistency. So be rest assured that we'll continue to buy till the time it is lower than the market or complete the market.
So, sir, what is the mix right now? Third party mix?
Say, in case of lamps, we try to get 100% from Tata Steel because it is much higher, better quality. In case of fines, we try to get low phos variants from market, and that varies in today's market, 25 to 35 to 40%.
No, so overall, from a fines perspective, I think you tell them what percentage is bought from the market. That's what he wants to know.
Yeah, so 25 to 40 average 25 30.
Understood, sir.
1/3 is bought from the market in the case of fines.
Okay, sir. So my second question pertains to our price escalation. So you said that the current orders which are coming at almost 50 to 60% higher than what it was last year. I just wanted to understand, are these still a fixed price contracts, and in case raw material prices goes down, we stands to benefit, or these contracts have a price escalation clause linked to pig iron? So in case tomorrow if raw material prices goes off, we tend to lose the additional or the swings which we could have got otherwise.
No, so most of the orders are fixed price contracts because the contracts are taken by the EPC contractor. And the orders that we have with the EPC, like L&T, Voltas, Tata Projects, Megha, so all these guys, then they have a supply contract from us for the DI pipes. These are typically, I would say, fixed price. Wherever we supply to the government, and in some other cases, it is linked to the WPI of pig iron. So if the pig iron prices move, we get an advantage. But the percentage of that order in our books is pretty low. For us, most of the order book would be fixed price. And therefore, anything that we are booking now for the last 6 months would be certainly advantageous as and when the raw material prices come down.
Understood, sir. Understood. So just one last question, if I may squeeze in. So out of our total capex plan, how much we have already spent and how much is pending, and how would be the spread over FY23-24 in terms of capex spending?
I will request Shubhra to answer.
So the total capex, we are still left with to spend around 95 to 100 crore on the growth capex. That will spend in FY23. Over and above, we have, as Edwin has earlier explained, that blast furnace 2 will be rebuilt in a capital repair. There also will spend money, and also on the sustenance capital. So these three heads predominantly, all put together, we'll try to spend 250 to 300.
Understood, sir. Thank you for answering my question, sir. Thank you and all the best.
Thank you.
Thank you. I would only request whoever is asking the question to introduce himself and the organization he or she represents. That would be useful for us to relate them.
So, sir, I am Vikas Singh from Phillip Capital.
Okay. Thanks, Vikas.
Yeah. So, Ashif Patel, you may go ahead and ask your question.
Hello, sir. I'm Ashok Patel from Molecule PMS.
Yeah, hi.
Sir, my question was regarding given that pig iron prices have seen a sharp up move since February. Meanwhile, coking coal and iron ore prices have softened. So, how are we placed in terms of currently the spreads compared to Q4?
See, right now, pig iron is actually booming. And why? I'll give you the reason. This now becomes more of a structural reason. The Ukraine-Russia war or the conflict has actually disrupted the supply chain from Eastern Europe, from Ukraine, Russia, who are the very large suppliers of pig iron. And therefore, there is a shortfall of pig iron in the international market. With the result, the pig iron players have started exporting. We don't export much, but our other peers and competitors are exporting in large quantities. Now, again, to give you a sense, in the last 2 months, the order booking of pig iron is upwards of 300,000 tons, so 3 lakh tons from India. When in a quarter, on an average, the exports are never more than 50 to 70,000 tons. So you can imagine, so there is a major shortfall of pig iron supplies in the domestic market, which you will see and which you will continue to see. So a lot of people ask me that raw material prices come down, the pig iron will come down. I said no. Why it will not come down immediately is because of the supply-demand mismatch. The raw material will indeed will ease off the pressure, and as and when they come down. And you rightly said there has been some softening, but pig iron prices have not come down. Pig iron prices are booming. So, in fact, it's only started booming in March after the impact of Ukraine-Russia conflict was visible. And because the sanctions are likely to continue on Russia and Ukraine's industry is destroyed, this phenomena is going to continue for a year or two, is how we read it. The rest, of course, we have to wait and see how things go.
So, sir, can we expect in the case which you mentioned, can we expect the pig iron segment margins to return back to the level it were in like few quarter back?
Yeah. So pig iron margins will be absolutely robust. There's no doubt in that. Okay. It all depends on whether raw material prices come down to more reasonable levels, in which case our spreads go up and we have a fantastic margin. While in the case of DI pipes, you will see a more stable margin and more long-term benefits.
Sure, got it. And sir, once your second plant of DI is online, then we can say that we'll be having only capacity to merchant sell around 1 lakh metric ton of pig iron?
No. Let's say about 2 lakh tons. 2 lakhs plus. See, sure. Our production of pig iron, of hot metal, is theoretically we can produce about 6 lakh tons because both the blast furnaces have been misfiring for the last 6 months. One is up for major repair, which is it's reached its end of campaign life, and therefore we don't expect much. We are not able to push it. And in the other one, there have been some other issues. Once these get fixed, I think we should be able to cross 6 lakhs easily. And if we can do, let's say, 4 lakhs plus from DI pipes, balance will come from pig iron.
And sir, we are seeing, as you mentioned, we are seeing strong traction in pig iron exports. Is that understanding right?
Absolutely. I just mentioned the figure of 300,000 tons booking.
Sure.
Yeah.
Okay, sir. That's all from my side.
Right.
Thank you.
Thanks.
Yeah, Saket Kapoor, you can go ahead and ask your question.
Yeah, namaskar, sir. And sir, firstly, Shubho Navabashar, sir.
Shubha Navarsho, Shakir, at
Yes,
least
sir.
switch on your video. Let me see you.
Yeah, definitely.
Shubha Navarsho.
Yes, sir.
Sahil
Sahil bhai, please. Yeah. Sahil bhai, please enable my video.
Oh, acha, is that done by?
Yeah.
Anyway, sir, you can do it yourself. I don't have the cartoon. Yeah.
अच्छा सर यहाँ दिखा नहीं रहा है. And anyways, I'll just check it out. Sir, firstly, sir, a clarification on the capex part. Subrata, you mentioned that we are going to spend around 95 to 100 crore for FY23.
Shakir, what I have said for the growth capex, it will be 95 to 100,
Okay.
which is pending and which will be done in currently.
Okay.
Over and above, we have got BF2 rebuilding,
Right.
and there also we'll spend another say 90 to 100.
Okay.
And also the sustenance capex, a lot we are spending on the digital automation and also another cost related projects. There another say 80 to 90 crores. So all put together, we'll be spending in a region of 250 to 300 crores.
250 to 300 crore. And currently our capital work in progress has gone up by 100 crore. If we take the March 21 numbers and March 22.
Yeah, because we have spent this year around 325 crore. Out of that, on the DIP side, we have capitalized approximately 200 crore, mainly those things which has got already commissioned, like on the melting, to casting and annealing.
So the capitalization will happen, sir, in the first quarter, I think so.
No. Shakir, so totally say DIP is say 450.
Okay.
200 crore we have approximately 200 crore we have capitalized in March. Say 150 kind of things will be doing the first quarter, and balance 100 maybe in the last quarter or first quarter of next year.
Okay, right, sir. Sir, as you mentioned about the higher royalty charges for iron ore, on an absolute number, what is the impact for this full year, sir, with the implementation of higher royalties?
For whole year, the impact is 151 crore. 151.
151 only on account of iron ore.
Yeah, it is on applicable only in iron ore only, and also coal, but we do not buy coal from Tata Steel.
Right, sir. Sir, and on the DIP order booking part, as mentioned by MD sir, that we have done a lot of order booking for the last quarter. So, taking into account the surge in raw material prices that have remained unabated, so are the margins protected as of now, or there also there is a compression on margin? The last 6 months order booking.
So last 6 months we have taken on a elevated number, and compared to last 6 months, if you see the coal graph, it was surged mainly surged in the month of March, but again in the April it has softened, and we did not have much exposure on March index. Coal iron ore has little bit softened compared to 2 months back. And therefore, the orders which we have taken in last 4 to 6 months, our margin are still protected. But there are issues on those, what as MD was explaining, those were for the FY21 orders.
Last point I didn't get, sir.
So, okay, to make it simple, those orders which we have taken in last 6 months is at higher price and the margins are protected.
The margins are protected. So I would also like to thank the board for this time the higher dividend payout at 8 rupees per share and 10% of the profit being distributed. Earlier, we were always looking for a better dividend payout from Tata Metaliks. So thank you for improving on that front also.
Thank you. But just to note that this is highest ever. Tata Metaliks maybe in 27 years has paid dividend maybe for 18 to 19 years.
Right, sir.
80% is the highest ever. Last highest was 70% in 2008.
Correct, sir. Just 2 bookkeeping questions and come in the queue. Sir, in the investment part and the current asset, there has been an investment of 60.30 crore. What will be this attributed to, sir?
So there are two types. So one is that we have got 150 crore intercompany deposit with TSDPL. Okay, that is one set of investments we have got. Second set of investments we have got that which are on the mutual funds on the one night mutual funds.
Not able to hear you, sir.
So one set of 150 crore we have got intercompany loans and investments that we have given to Tata Steel Downstream Limited, that Downstream Products Limited. Another 60 crore you'll find in the mainly in the mutual funds, overnight mutual funds on that.
Okay.
So you'll find that our total cash and cash equivalent on a 31st March is 337 crore.
Sir, I will come in this.
Okay.
So Saket, what Shubhro is saying, he is now very rich.
Sorry,
He started disbursing money to other corporates, and that's where the money is. You're seeing that.
Right. Right. So I'll come in the queue for my follow-up, sir. And thank you, sir. I'll just try to set the camera setting.
Yeah, that will be nice if you get your camera also. You get to see people when they ask questions is always useful.
Thank you, sir. Thank you, Sahilji.
Yeah. Okay. Thank you. So the next question we have from Shubham Agarwal. You can go ahead.
Can you hear me, sir?
Yeah, we can hear you. As I requested a little back earlier, as we are on video, whoever asked the question, if you can also be on video for as long as you're asking the question, it will be useful to get some connect.
Fair enough, but I don't think so. We have that option with us. I think there is some only the organizer can do it. I'm not sure, but we don't have the option.
No problem. We'll try and see that next time it is there. If it is not there, just go ahead, please, Shubham.
Perfect. So my question is largely on the industry side of DI pipes. So as we have seen recently, there has been a few announcements as far as new capacities are concerned. So almost in the next 2 to 3 years, we are expecting 1.5 million ton to come as new capacity. So in this scenario, how do you see the demand demand supply situation for the next 2 years? If you can throw some light there.
Yeah, Shubham. So, the projections and the announcements by the government of India on water infrastructure projects is just too fantastic. Okay, and I'll give you some numbers. Today, or rather, let's say in FY22, Government of India released only 20,000 crores for the water infrastructure projects, as against, or rather, they allocated 40,000, but actual release was 20,000, and the budget was, let's say, upwards of 90,000. Because of 2 waves of COVID last year, and because of the surge in prices, people could not use the pipes, they could not complete the projects, and therefore there was a hit. What we have calculated, that considering the budget of FY23, which is about 60,000 crores, and the spillover of FY22, the total money available on water infrastructure projects only by the center is 1,32,000 crores for FY23. An equivalent amount will come from states. If you take this and calculate and say, let's say only 15 to 20% gets spent on DI pipes out of this, you can imagine what number we are talking about. But the problem is that the government is willing to spend that much of money, allocates, but in reality it is not able to spend because of various reasons. So let's keep our, numbers much more conservative, because as I said, in FY22 they spent only 20,000 crore. So this is just to give you a sense where the numbers can go. From 20,000, it can go up to 1,32,000 if the government has the wherewithal and the capacity to actually complete projects. This is one aspect. Now let's come to hard numbers on DI pipes. The industry order book today is roughly about 1.4 million tons. That's about 7 months of order. There are about 1 million tons of inquiries in the market. So that makes it 2.4. Then there is tender of about roughly 0.9 million tons, which is already floated for the EPC contractors, not for the pipes. So the EPC contractors get it and then they in turn give it to the pipe suppliers. And projects approved and tenders being prepared to be invited is about 2.5 million tons. So if you look at the total number, it comes to roughly 5.8 million tons, let's say 6 million tons. The industry capacity is, let's say, 2.5 million tons. If you are saying 1.5 million tons more comes up, which I doubt very much, then the industry capacity becomes 4. And we are saying we have theoretically an order visibility, either an order visibility or projects visibility of about 6 million tons. So that's the kind of numbers you have. But more realistically, I don't know from where you got 1.5 million tons, but the number that's more practical is that we will achieve, we'll go up to maybe closer to 3 million tons by end of this year. And that also is not easy. So DI pipes will continue to be in short supply, in my opinion. And I think the industry is going to have remain in a positive supply demand situation. Does that help or is it too complicated?
Yeah. Thank you for that elaborate answer. Secondly, I would like to understand how difficult it is for a new player to come in this particular industry, because I believe 2 new players have already announced their venture into DI.
Yeah. So one is Welspun. I don't know who's the other one, but
Concall Manganese.
That they have announced. So this is going to be a long drawn affair. You know how long it takes. So you can announce a lot of things. In reality, to come in will take time. Plus, the entry barriers are extremely high in DI pipes. Both operationally and on the market side. So, many of the projects, they require you to have supplied material for last 5 years, 3 years. So many of these new players are likely to struggle for the next 3 to 5 years, because many of the orders will not come to them because they do not have the credentials. But it is possible because the demand is so much that they might have a slight easier run than what players in the past have faced. So let's see how it goes. But on the whole, setting up a DI pipe industry is extremely difficult and long drawn. Even if you are a smart, efficient player, you will still need at least 2 years to complete it. And I'm not even taking the environment clearance, etc., which will take anywhere between 1 and 2 years. So things will get added up to the industry, but they will take time.
Okay. And secondly, in a few of the recent orders, I think we have observed that they have mentioned HDEP pipe. Is this a substitute for DI, or how does it work?
So HDPE pipes is a substitute for DI pipes, absolutely right. But they are more competitive in the smaller sections.
Okay.
So broadly, the industry-wide characteristics is like this. Up to 300 mm, it is DI pipes and HDPE. Between 300 to let's say 800 or 1000, it's primarily DI pipes. And beyond 1000 is primarily steel. This is a very broad, I would say, characterization of the industry product usage, or rather the material usage. Okay. Our sizes are, Tata Metaliks sizes are, we like to play in the 300 to 800 mm. Although our expansion takes it up to 1200 also. In China, they make DI pipes up to even 3000. But in India, the maximum is 1200.
Got it. And lastly, my question would be on the coke side. So currently, basis our capacity, what is our total coke requirement?
Shubhram?
Yeah, it will be approximate 15%. And if you talk
Shubhram, your volume is not good enough. Can you increase your volume? Come closer to the mic. No.
Sorry. It is the total requirement. Only 85% is backward integrated, and 15% is we are exposed to market.
Okay.
If you go by the absolute terms, it is 4,000 kind of monthly. with annually 50,000 tons.
And for that entire 85, how much coking coal are we procuring? What is the total volume?
Say we have got a capacity of approximately 240,000 ton of coke, and that requires approximately 3.5 lakh ton of coal. Over and above, we also need coal for coal injection, PCI coal injection.
Got it. Yeah, thank you. That's it from my side.
Thank you.
Yeah. Karthik Arya, you may go and ask a question. Go ahead and ask a question.
Hi, sir. My question is regarding first it relates.
Can you please introduce yourself first and then go ahead? Sorry to interrupt.
I'm an individual investor. Right. So first query is regarding pig iron. So as we see the exports are running, shooting up like anything. So in the previous quarter in Q3, what percentage of export and domestic would be the like the bifurcation, and second would be what is the trajectory that we are looking at for TML, considering we had a shutdown, and like what is the current position on that, and what is the future going forward? Also, I think first we can go with this.
So what was the first question? I missed it, Karthik.
Since the pig iron export prices have been running like anything, and domestic, maybe the prices might not be shooting up that much. So what is the future trajectory regarding this? And also in Q4, what has been the, let's say, bifurcation of an export and a domestic?
Yeah. So, we have traditionally concentrated on the domestic market, but we have exported also. I think Q2 or Q3, we did a very large quantity, I think 15,000-20,000 tons to China or somewhere, brick bulk shipment. But otherwise, traditionally, you can say, we hardly, sell. I think we sell less than 10 to 15%, something like that in export market. So 10 to 15% of our pig iron sales is in the exports market. It's an opportunistic play. If prices are good, more attractive, we'll certainly look at that. But we have some regular customers we like to service. We more like to not starve them of pig iron, and therefore our concentration is more in the domestic market. Plus, we supply mainly the foundry grade of pig iron, which is used by the castings players, whether it's for auto or for engineering or for whatever. Most of the exports that's happening is the steel grade, where we don't concentrate making that grade, although we do make, but not much. So that's the difference. But depending on the margins, we can easily make that and supply and export. So that's not a problem. Q1, as far as your blast furnace question is concerned, I think we continue to face some challenges on the blast furnace end. As I said, blast furnace number 2 is going for major overhauling and repair towards the end of this year. So it will continue to struggle, or let's say work under suboptimal conditions. So we will be having a little bit of a challenge there. And blast furnace 1 also, we have been facing some trouble, although we got back the blast furnace 1 in March. So we need to make sure that, the rest of the year we are able to operate efficiently. And as actually the blast furnace 1 is also under some kind of augmentation as part of the expansion project. So there will be some ups and downs, but I believe that after, we have expanded that in Q1, we should have a smooth running in the larger blast furnace, which is the blast furnace number 1. Have I answered your question? Or what else was your question?
Yes. Just one more thing on this. So regarding shortfall, any particular number that we are looking at for Q1? Shortfall of pig iron?
No, so not really shortfall, but I'm saying that it will not operate at its peak efficiency. That's the point I'm saying.
Okay. But all our furnaces will be operational?
Yeah. And we will be taking some regular shutdowns, etc. See, what happens is when your blast furnace has reached its end of campaign life, its efficiency level comes down. It starts creating some problems. You need to take frequent shutdowns to, repair it as and when things happen. So that's a little bit of uncertainty. We've actually stretched the furnace over last 2-3 years, because we were able to run with it, and we took the capital shutdown program and the budget in this year. So once we repair it, we go in for a major overhauling. It will be, it will be a far better furnace, because you can imagine we had this furnace, I think in 2012, Shubhro. When did we blast furnace 2, the last one we did?
2012.
2012. So it's almost 10 years. So that's the problem. It's typically it will last you for about 7 years or so. So we are 3 years above it. So that was just I was just flagging that don't get surprised if you hear from time to time issues on blast furnace. Otherwise, all other DIP continues to be operating at best ever numbers. Coke oven, power plant, sinter plant, I think the rest everything is doing well, but except for the blast furnaces.
Right. That answers my question. Thank you, sir.
Yeah.
Right. Anurag Patil, you may go ahead, introduce yourself and ask your question. Anurag Patil. Anurag Patil, please go ahead and ask your question. Okay, until that we'll move to Akhil Hazari. You may go ahead and ask your question.
Hello, my name is Akhil Hazari from Robo Capital. Am I audible?
Yes, we can hear you.
Hi. So I just want to know what are the volumes, the total volumes that the company did, in the previous years, FY20, FY19 around, which would be DI pipes plus pig iron.
Shubhro, we would like to take that.
Say that DIP this year we have done 237, last year 290, year before that FY20 we did also the 230 plus, and FY19 2 lakh plus, but exact number I don't recollect, but I can share you separately. Similarly, so the 237 is the highest ever, keeping in mind that our nameplate capacity is 2 lakh tonnes. Same thing for the from the hot metal side. Last year we did 466 KT hot metal. This year we have done 565 KT, and FY20 approximately 550. And based on the DI pipe, the balance goes to hot metal. The balance goes for pig iron. The pig iron this year we did 344 KT, and last year it was 283 KT. Is it given some trend or giving some understanding?
Yes, definitely. So and coming here, the company is planning on doing 6 lakhs in total,
so,
right?
So yeah, so we expect that 6 lakhs at minimum, and we definitely will try to sweat our asset more, and we can try to reach say in between 6 lakhs to 6 lakhs 20. Our DIP capacity nameplate would be say 4 lakh, and we should try to do 4 lakh 20, 4 lakh 25 kind of number. And the balance 2 lakhs will be on the pig iron side.
Right. And regarding margins, so the margins purely depend on whether the raw material prices come down or not going forward. So
that's true, but as MD sir was earlier also, and in earlier calls also, we have time and again said that DIP margin will be always higher in a steady state manner and in normal circumstances. And if we see in the long run, if you consider iron ore to DIP, the margin will be, EBITDA margin will be 20% on an average. If you take an average of 2-3 years, 3-4 years, and our objective is to take it to north of 20.
This would be only for pig iron margins, right?
No. I am saying the DIP. DIP margin right. On a 3 to 5 years horizon, it should be always approximate 20% of EBITDA margin, and our objective is to do north of 20 through the cost measures and all.
And the pig iron margins would be, what, any guidance that you could
Pig
give?
iron, that depends, and pig iron, it is always that we can pass on a large portion of the cost to the customer. So we can have if you take a longer term, we can have a 15 to 18% margin definitely on the pig iron. Last year, the scenario was different. Pig iron gave much higher margin than DIP, but the numbers I have talked is more of a 3 to 5 years kind of horizon.
Right. Okay, fine, great. Thank you. That's it from my end.
Thank you.
Ritika Tiwari, you may go ahead and ask your question.
And I'm an individual investor. My first question is that while we have seen a hike in the prices of steel grade, so in the last quarter, whereas
we can't hear you properly. Your voice is, I think, breaking. I think there is some echo as well. Can you fix your mic closer to it?
Hello, sir. Now am I audible?
Still there is an echo. I would suggest you log off and log in back.
Just 1 minute.
Yeah, this is better.
Hello.
Yeah, this is better.
Yes, sir. So my first question was that since the prices of pig iron have shot up in the last quarter as well, and I think they are continuing now also. So is there any traction? What kind of traction do you find in the demand on the domestic front for foundry grade? Like, is the demand stagnant, or people are still continuing to raise their demand basis the material availability?
Typically, the castings players have a contract for about a quarter, while they buy it on a spot basis from us and from others. So it takes time for them to pass on the prices to their customers. And obviously there has been resistance, and people think we have reached the highest point, and therefore it may come down, and therefore there is a lot of resistance. The capacity utilization of the foundries has come down from, let's say, 70% to, let's say, more like 50%. But I think the foundries will very soon realize that there is no point in holding on. They need to pass on the prices, because it's a structural issue. It's not that it's a temporary issue. Even if the raw material prices come down, the price of pig iron should remain high, as I explained a little while back, because of the Ukraine-Russia conflict. And Ukraine and Russia are large suppliers of pig iron to Europe and US. That's got completely stopped, and therefore Indian pig iron is now going to US on a large scale. And therefore there is going to be a shortfall in the domestic market, which is going to continue. My sense is it will continue for longer, and longer could be even 1 year, 2 years. So therefore, I think we are in a very robust position on the pig iron side. The raw material prices has its own dynamics, and that should not influence the pig iron prices. But the pig iron prices should remain strong. That's my sense. We'll see how it goes.
Oh. Okay, thank you. So on the other hand, on the raw material side, since we must be having some high cost inventory on the coal front of the last month, maybe in March it reached its peak. So will it have its impact on Q1 also, or have we lower cost inventory booked also, shipments booked for Q1?
So you've already seen the impact of high cost inventory in Q4.
Right.
March was the highest, but we didn't buy much in March. We did buy, but not much. April it has started coming down, and then so prices are better, but not the same as in March. But we'll have to wait and see how things go in May and June, as far as the raw material cost is concerned. But in general, definitely the costs are on the higher side, though not as high as in March.
Thank you, sir. And sir, just one more thing. You said that you have ended up at a very low inventory on pig iron side. So can you assign it a number on the basis of number of days, inventory days? If you can guess how much inventory is left.
I can tell you the number. We squeezed out every ton of pig iron, so it's virtually close to zero. So you can say less than 1,000 tons. Okay. Never the lowest ever. Even on the ductile iron pipe side, less than 2,000 to 3,000 tons. You see, there will be some hot pig, there will be some hot pipes coming out which you can't dispatch. Leaving aside that, every single ton has been moved out. The highest ever sales of both pig iron and DIP we did in FY22. Despite all that, our profitability is still not the best ever.
So for pig iron, there was no challenge for lower demand in the domestic front because of the material availability thing?
No. There's no issue. In fact, you will start seeing a shortfall more and more, I think, in this quarter of pig iron, because people have booked. You see, the Ukraine crisis started when? In February, second half of February. The impact was felt in March. Okay. And then people realized, oh, there's no pig iron. So they started booking. Now the orders will get executed, and therefore you will start seeing the impact of that. So whatever price rise you saw in March was more sentiment. Now you will start seeing the real one, which we have started seeing in April. So April, May, June is going to remain pretty strong for us. The only problem that we are facing, as I mentioned, is the strong resistance by the foundries, because they are not able to pass on those prices. But I think it's a matter of time, because I don't see any other option.
Right. Thank you so much, sir.
Yeah, right.
Yeah. So I just have two questions before we move on to repeat questions. Sir, what would be our order book right now on DIP?
Our order book would be, let's say, more like 7 to 8 months at the moment.
Okay. And Sundar sir, the capex that you've said about the sustenance capex and for the rebuild of blast furnace 2, that will be all spent in FY23, or would we spread it over to FY24 also? So the whole total capex all will be spent in FY23.
Rebuild of furnace 90% will be in FY23, and sustenance, digital automation, robotics, it is a continuous one. What I was trying to give the guidance was that total capex, one on DIP2, blast furnace 2, sustenance, robotics, all put together, it will be in the region of 250 to 300. And this number will vary based on the amount you are generating from the operations.
Okay, got it. Thank you, sir. We just have a few more questions. So, Sunil Jain, you may go ahead and ask your question. Mr. Sunil Jain?
Yeah. Thank you very much for this opportunity. I'm Sunil Jain from Nirmal Bang. Most of the question answered. Only one question regarding coking coal. What was our average cost of coking coal in Q4, and how it is likely to move in Q1?
Subro,
I'll try to answer. What I can tell you about the Q1 of FY23, because as the coking coal prices are going up, we are trying to look for a newer blend to keep the cost contained. But nevertheless, we'll be having in Q1 average cost or blended cost in between 36 to 38,000 on a dry basis, which if you convert back, it will be in the region of 400 to 420 kind of CIF India. So this is on a blended basis and various types of coal together. So that if you talk about 1 quarter back, it will be approximate 8,000 rupees lower. So 30 to 38, 36 to 38 would be 28 to 30. Could I answer you?
Yeah, 100%, sir. Yeah, thank you very much. That was my question.
Mr. Anil Jain, you may go ahead and ask your question. Mr. Anil Jain, you may go ahead and ask your question.
Yeah, am I audible now?
Yeah.
Yes.
Yeah. Pardon me if I have missed the question. I just wanted to know about the timeline of merger with the Tata Long Steel Products.
Yeah, I already answered that, saying that you may get to know something from Tata Steel. Since this is a long pending question and keeps coming up, I don't want to repeat the same answer. So, the procedural delays have been there, and I don't want to keep, appearing and giving you all kinds of reasons. I think you'll get to hear, I think, because there are 4 companies involved. So I'm sure Tata Steel will give you an answer sooner than later.
Okay. Thank you. Thank you, sir.
Yeah.
We had a repeat question from Ashok Patel. You may go ahead and ask.
Sir, my question is regarding the fact that you mentioned that we are facing sort of resistance from domestic foundry players, that they are not able to accept the current higher prices. So just to understand, theoretically, we have the process and infrastructure in place to export pig iron in case the domestic foundry doesn't show the direction the way we expected. Can we export the entire supply?
So obviously, you are not serious when you're saying export the entire supplies. What you mean is, and if I've got you right, is that can you ramp up your exports? Of course, yes. We prefer to sell it in the domestic market, primarily because the realizations are better. We have old customers, long-term customers, and we like to continue the relationship and not starve them. That's number one. And as you would have seen, that we are continuing to honor the DI pipe contracts, which were, let's say, at 50 to 70% lower prices than what you have today. And we are one of the very few companies which is doing so in the industry. And you can ask the customers. So we don't want to deprive or, let's say, go away, make our customers lose faith in us. So we'll continue to supply. But obviously the SKU will go more towards exports as we go forward, because the export prices are booming. And we will take a call depending on how much the industry is willing to accept the prices. I just mentioned that the industry is still having difficulty passing on the prices to its customers, and therefore there is capacity utilization of the industry has come down from, let's say, 70%, 75% to, let's say, about 50%. But it will, I think, go back as they are able to pass on the prices. It's still early days. If you realize, the prices have started moving up significantly in March. And so it's been a month and a half. So you have to give them some time. They have more longer term contracts. So they are struggling to do that, but they will do it because there's no option. Otherwise, they will have to close down. But to answer your original question, yes, we can ramp up exports if required. And we'll be seeing more exports as we go forward.
So broadly saying, sir, always the domestic pig iron prices of foundry grade are in line with the global prices? Or can we see a discrepancy there?
See, what happens is the foundry grade is not a bulk commodity. Foundry grade, typical foundries, they take small quantities. So we have distribution model and we supply to them and we get good prices because of this distribution model. Imagine a bulk buyer versus a retail buyer. Okay. Plus making foundry grade is more difficult, maintaining quality, etc. So our competition is also limited. So that's why we concentrate on the foundry grade. The steel grade everybody makes. You can make it in bulk and ship. Right now, the steel grade is booming. So is the foundry grade. But foundry grade, the supplies quantity can be only limited. So what normally we do is we then make the steel grade or the basic grade pig iron and sell that, whether in the domestic market or export market. That is the logical thing to do. And we will do that. If we don't find enough takers at our desired prices, we will do that.
Sure, got it. So, sir, broadly saying, if all the monitorables in terms of current pig iron realization and input prices and everything remains stable as it is right now, can we say we can expect Q1 which is starkly different from Q4 which we just witnessed when it comes to pig iron?
No, pig iron actually in March we got a lot of benefit. And I think that same benefit will continue into Q1, maybe somewhat more. Maybe the spreads will improve if the raw material prices continue to soften. That is, Paplu, which we don't know what will happen. Raw material prices has its own, let's say trajectory. At the moment it has softened, but let's see how long and what. So all in all, Q1 for me, the pig iron looks to be good at the moment. Whether it will continue to remain good is a challenging question. But from today's point of view, it looks better than last quarter.
Sure. That's all from my side, sir. Thank you for detailed explanation. Really appreciate it.
Thank you.
We have two more repeat questions. Two more questions. Shubham Agarwal, you have a question. Please go ahead.
No, so my question has already been answered. Thank you so much.
Okay. And I think Saket, you have a repeat question.
Yeah, Sahil, thank you. Sir, if you could give us some color, what were the exit prices for pig iron for March and what are the current prices trending, sir, to get an idea of the trajectory?
So the last prices in March and the prices that you are getting in April, there has been an increase of, let's say, 4,000 to 5,000 rupees over March. Now, I will not be able to say exactly if you say exit prices, but overall, compared to March, there has been an increase of 4,000 to 5,000 rupees per ton in April.
Okay. And as Subro sir has mentioned that the impact of coke was from 30,000 to 38. So that is an escalation of 8,000 rupees. Am I correct on that, sir, or from Q4 to Q1?
Shubro, please answer.
Yeah, but
Mike.
NR is on the 100%. Coke is based on the usage. So the impact will be half.
Impact would be half, but sir, the trend is from average of 30,000, it has gone up to 38.
Yeah.
What you mentioned.
But that I have mentioned based on the quarter on quarter. But what MD sir has explained based on the month on month. So there will be little here and there.
Plus, even the number that Shubro has said is a very approximate, it's more of a thumb rule kind of.
Yeah.
Today you want to use that as a thumb rule, so he said 6,000 to 8,000. So in actuals, it depends on the blend, what kind of coal you have used, how much of PCI you have used, so all that.
Right. Sir, in the similar way, have the scrap prices also moved up? Some of the players who are doing casting work, or do they have any arbitrage play in that sense? Just to understand, the pig iron prices were shooting up. Will it have a direct impact for the scrap market also?
So interestingly, the scrap prices hasn't moved up so much. Okay. And so obviously, the players will like to use more scrap and less pig iron, but then scrap has its own availability issues. And beyond a point, depending on the kind of furnace you use, you can't use scrap. You need to use pig iron.
Right.
So if there is a furnace, they will need to use at least 50-60% pig iron. If it is induction furnace, they can do with maybe 20-25% pig iron. So there is a whole lot of, variance. So you will not be able to accurately assess what is going to happen where. Right. But to answer your question, scrap prices haven't increased the way pig iron has increased, is right.
Right, sir. And a small point on the depreciation front, Subrodha, as you have mentioned that we have capitalized the projects worth 150 for this year, the depreciation for the year on year has gone down from 67 crore to 61.70. So if you could explain the reason for the lower depreciation, although we have capitalized the projects.
Yeah, so the capitalization took place on, say, 28th, 29th March.
Okay.
So do not have any impact in FY22. That will have an impact in FY23. That's the first thing. Second thing, that now Tata Metaliks has crossed almost 25 years of the presence. So a lot of assets which we have bought in 94 to 2000 now got fully depreciated. So that's why one of the reasons it is falling year on year, it is coming down. So the impact of the DIP2 will be felt in the next year. So on a FY22 as the base, the depreciation may go up by approximate 10 crore kind of number.
10 crore kind of number. And on the last part, on the profit on disposal of land, sir, what was the total sale value, sir? This is the profit 31 crore we have booked.
Sale value was approximate 43 crore.
43 crore. Right, sir. Sir, just to sum up, Sandeep sir, taking into account the impact of the hardening of raw material prices and consequent the jump in the pig iron, there is a better realization on the pig iron front. However, with the legacy order book still not fully not executed, we will be having an impact on the DI pipes margins for the first quarter. This will get mitigated by the first quarter itself, the old legacy, or will it percolate to the second quarter also, sir, second half?
So I gave you an idea that roughly 1/3 of the orders in FY23 will be the old legacy orders.
Right, sir.
That doesn't mean we will execute everything in quarter one.
Right. There will be a blended basis.
Yeah, so you'll get a, so we will play it along. And also the fact that pig iron is more profitable, we will also like to maximize pig iron. It's a logical thing to do, isn't it?
Okay.
So I think we are seeing we'll play.
ड्राइवर को टमाटर मंगाना है टमाटर और धनिया
I didn't get
tomato. Good.
Yes, sir. Please continue.
Okay.
No, I didn't get the last point, sir.
No, so
because
I
of
said,
tomato and dhania.
Yeah. So basically, we will play this, margin maximization game.
Right, sir.
But balancing out customer needs.
Right, sir.
Every quarter in FY23. It will not be only quarter one. But as we go on, I think quarter on quarter you will see this.
Right. But here also we have a disadvantage because of the blast furnace not working at optimum level. Had that been the case, the pig iron volumes would have been more robust. This is what one could sum up.
Yeah. No, so you're right. So there will be some impact of that, which we have also already seen in quarter four also. Otherwise, we could have done even more. And I think that will continue at least till quarter one. And I hope that we can get over it, at least part of the problem by quarter one, because we will be taking those annual shutdowns, etc. So you will have some of those things.
Right. And lastly, we will be hearing something finally we will be hearing affirmative thing from Tata Steel on the merger story once for all. This should happen in 1 quarter time, or it will take longer than that?
No, what I said was that you will get to know and get a better picture from Tata Steel, because that's Tata Steel is our parent. So
right,
you will get to hear from them sooner than later as to where do we stand. I know this is a oft-repeated question. I'm sorry, I don't want to answer this question because I think
correct, sir.
We'll get a complete picture, because I can only give you one side of the picture. You'll get a complete picture from Tata Steel, and I'm sure they will answer it sooner than later.
Thank you. That's all from my side, sir, and all the best to the team, sir, for a good.
Thank you. Thank you, Saket.
Thank you, sir. Thank you, Sahil bhai, for giving the opportunity. Thank you, Subhra. Thank you.
Yeah. So I think that's all for now. Thank you so much, Sandeep sir and Subhra sir, for elaborately answering all the questions. We will definitely improve on this video call experience in the next call. And would you like to give any closing comments, sir, Sandeep sir or Subhra sir?
Yeah, I like to just make a couple of points. So overall, I think the investor community must understand that, let's say if our profit this year was, let's say 338, 339, whatever, and we have lost out, let's say about 150 crores, and I'm comparing to FY21 on account of iron ore royalty. So our profits were, let's say, closer to 500 crores if you had not taken that into account. So on a like-to-like basis, because I am talking about a lot of improvement in the operational performance, but the results are not there. It's only marginally up compared to last year. But we must see it in the proper perspective. So about 150 crores if you add, we are closer to 500 crores. And also if the DIP old legacy contracts, if we had, let's say, if it had not happened, and let's say as we go forward, things will get evened out, we are in a much better position in terms of profitability in the coming, I would say years. So, and this is considering the fact that the DIP2, the expansion project, first phase is nearing completion, and therefore we would also have volumes coming in from there this year, and the DIP phase 2 will get completed by, let's say, end of this year or early next year. So we are in, from a robustness point of view, financial health point of view, we're great, but in terms of profitability, I think there may be some disappointment, but I just wanted to clarify it's temporary, and the future looks pretty good to us, at least from a really resilient Tata Metaliks perspective. That's all. Thank you, Sahil. Thank you for organizing. Yeah. Thank you to everybody for taking the time off. and asking us these questions. Thanks.
Yeah. On behalf of Monarch Network, we thank all the participants. This concludes the call. Thank you, sir. Bye, sir.
Bye-bye. Thank